right, so in this video, we're going to be talking about how to identify, how to find, how to choose the absolute best, the absolute highest probability order blocks in your trading. All right, because I know it can be kind of overwhelming which one to go with, but I'm going to tell you how to pick the absolute best. Okay, so we're focusing on quality over quantity. Step number one, when choosing the best order block, it needs to take a previous liquidity. So we're going to use this example today. I want you to look at my cursor, look where it's moving. See these series of up close candles here? That all makes one order block. So step number one is we want to see it take a previous liquidity pool. Did these series of up close candles take a previous liquidity pool? Well, it did. It took Asian session highs, and it also took these buy stops from New York session. Existing shorts that were in this play that were long after this displacement, that were trailing their positions, they're taken out of the play now. They're taken out of the play. Boom. As soon as it comes up, it takes out their buy stops and then resumes lower. That's step number one when we're choosing the best order blocks. It absolutely needs to take liquidity. It took Asian highs and it took New York highs. Boom. Step number one is complete. Step number two, we need to, shortly after taking those highs or shortly after taking that liquidity, you need to see a displacement. So in this case, since it is a bearish scenario, we want to see a displacement to the downside. We get it right there. What constitutes as a displacement? Your fair value gap. You need that fair value gap. It's absolutely necessary, which we got right here. So 1, 2, 3. See that? So you got your fair value gap right there. So it took liquidity, created your fair value gap on the displacement. Next, your order block, it will be in, so in this case, since we're talking about a bearish scenario, it's going to be in a premium marketplace. If you're bullish and you're on a bullish order block, the bullish order blocks will be in a discount marketplace. Okay, so it absolutely will be in a premium. So what we're going to do is we're going to take our Fibonacci from the high to the low. 50% equilibrium is right here. So see this? That's where we tap into 50%. So those order blocks, your bearish order blocks will be in a premium marketplace. That's key as well. So this is where the order block actually begins. I'm going to plot it on here real quick. That is where the order block begins. Right there. Why right there and not like right here? Why not the last bullish candle? Why wouldn't that be the order block and why would this be the order block? Well, you can use the last bullish candle if you want, if you just want to get like a more precise entry, minimize your risk a bit more. But it really begins right here. This is where it originated at, because you got to think. For one, like we've already stated, at this point, we're entering a premium marketplace. Right here where I have this horizontal line drew, that we're in a premium marketplace at that point within that price range. So it's in a premium. That's number one. But number two, this is the beginning of London session. This is the beginning of that Judas swing. These up close candles that took that liquidity, that's a Judas swing. That Judas swing, or most commonly our Judas swings, they will occur during London session. London session is where they want to purge that liquidity, that upper liquidity. So this is the beginning of Judas. This is the beginning of the Judas swing. This is the beginning of London session. And it's also the beginning of that bearish order block, because this is where it originated at. This is where that session began. And it's also in a premium marketplace. Okay. So so far, what have we concluded? Well, we need to be taking liquidity. It did it right here in this Judas swing. It took that liquidity. We needed a displacement. Boom. We got the displacement. We got our bearish fair value gap created. We need it in a premium. Boom. It's in a premium right here. That's where we enter a premium. And that bearish order block, it needs to be nested. This is key. It needs to be nested inside of that fair value gap. It needs to be inside of it. Okay. Whenever you have that criteria where it's inside of the fair value gap, it becomes a very, 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 very sensitive price point. Did I mention a very sensitive price point? It's a very sensitive price point. So you need to keep a close eye. You need that criteria because it's very, very powerful when you have that inside of the fair value gap. So taking liquidity, it needs to be in a premium. The order block will be in a premium if you're shorting. It needs to be nested inside the fair value gap. Again, you can use the last up close candle if you want to get a more precise entry. That's up to you. Where's your stop going to be on this? Your stop would be above high of day or your stop would be above that fair value gap high. As for a profit target, it's really up to you because we all got different ways of trading. You could shoot for a low of day. You could shoot for that 50 institutional price level. It's up to you. We all got different ways of taking profit.